Margie, let's start with you. Obviously, it has been, it's actually a nice to kind of close out a week on a relative high note here. Is this indicative to you of what's to come, or is this just simply a bear market rally?
No, I think it's definitely a rebound, a sigh of relief that the market thinks the Fed is almost done. There are signs of weakening, slower labor, and so forth. And so we can look forward under this scenario to seeing the Fed get ready to stop tightening and maybe even easing in the beginning of 23. And so we're seeing a big rebound. Standard & Poor's is up 8% from the lows in June, and NASDAQ up 12%, and interest rates are down substantially. The 10-year Treasury spiked up to 3.5%. It's now below 3%. But I think the market is just going to flop around here. I'm not looking for big moves up. I think we're just in a trading range.
Jim, do you think that, that there was some B of A data out this morning that showed that the market activity outflows actually haven't yet caught up with some of the bearish sentiment that investors and consumers are reporting, and that risk assets aren't necessarily reflecting that yet? Do you agree with that, or do you think that the current environment is pretty much priced in at this point?
I agree a lot with what Margie just said. I think that, with sentiment, Leslie, I think is really thoroughly washed out. The bear market's been 6 months in the making. Nervous Nellies have had ample opportunity to get out of this market and sell out. I think much of the selling is done. It's more a matter now of where the buying shows up. I think there's a lot of excess assets on the sidelines that could come back in if people get convinced, as Margie said, that this is a beginning of a new rally. So I don't know. I don't agree with that. I think prices are washed out. Valuations are much improved. Sentiment is really sour. A lot of people are waiting around for the second leg of the bear. And I agree with Margie. I think the Fed's going to maybe do one more rate hike to 2.5. It puts the Fed funds rate in the same zip code as free market yields are, around 3%. I think they're going to be done at that. I think this might be the last rate hike. And if the market continues to pick that up, I think as more and more people believe the Fed is done, we'll leave it with a positive slope yield curve. Recession fears will ease somewhat, and I think we've got a pretty decent rally here coming in the second half.
Jim, what do you mean that people think the Fed is done raising interest rates? There's an expectation we'll get all the way up to 3.5%.
Yep. I'm saying I think that if, to Margie's point, inflation to me is clearly rolling over from commodity prices to core inflation rates to wage inflation. And I think the inflation environment is telling the Fed it's time to wrap this tightening cycle up. Real growth has weakened considerably, as you guys have been talking about, telling the Fed it's time to wrap this tightening cycle up. Bond yields, as Margie said, have stopped going up from 2 years to 30 years. It's telling the Fed that they're comfortable now with rates. They don't need to raise them a lot more. And break-even rates, Leslie, the one-year break-even rate's gone from 6.5% in end of March to 3.5% today. It'll be back close to the 2% Fed target by September. So I can see the Fed doing 75 here in the July meeting, but by September, I think the case for further tightening is going to be gone. That's my view.
Margie, do you believe that the economy is rolling over at this point? And then if so, what tools does the Fed really have to ease from here? I mean, there's so much blame that's gone around with regard to QE and how responsible or not responsible it is for the inflation situation we're in right now. They probably won't be too quick to do any of that anytime soon.
Yes, they're really kind of caught in a box because inflation is high, likely to stay very high. But clearly, our economy is rolling over. Globally, economies are rolling over. And all over the world, central banks are tapped out. They borrowed so much money to spend for COVID. They really don't have any money left now to stimulate their economies, to help offset inflation of food and fuel and so forth. So they really don't have a lot of maneuverability. I think the Fed, as Jim said, they may well slow down on the rate hikes, but I'm not so sure they're ready to stop because inflation may well continue to be high. So I think we're going to see this two kind of markets. One, the more zero interest rate market, growth stocks that blew up in the last year due to a huge rise over the last, say, half decade. and more interest by investors on the sideline in companies that have more steady growing characteristics. So we saw social media sort of blow up, but the more ordinary companies, industrials, technology, healthcare, I think will do fine. Although I do think growth is going to be more slow over the next year.
Shepard Smith here. Thanks for watching CNBC on YouTube.